We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
The goal of this episode is to explore the differences between index investing and factor investing. But to get there, I'm going to ask you to indulge me in one of my favorite parallels from a completely different world. It's actually drawing from a portion of the book I'm working on, and for what it's worth, I also have an exclusive email list that shares outlines from the book, excerpts, and even has had subscriber-only webinars. So if you're interested in some behind-the-scenes access to my new book, you can get those updates by signing up at theperfectportfoliobook.com. Again, that is theperfectportfoliobook.com. If you ask most baseball fans what makes a great fastball, the first answer you'll hear is speed. And for a long time, that was the only answer. A fastball was great if it looked fast, if it sounded fast, if hitters swung through it with that late, helpless flinch that told scouts everything they needed to know. Before technology entered the game, velocity wasn't measured so much as admired. You had scouts sitting behind the plate squinting and declaring a pitch explosive or heavy or rising, and that was the extent of the analysis. The approach seemed to work well enough. When a scout's intuition turned out to be incorrect, it was usually just chalked up to a player not living up to their potential. But then radar guns arrived, and the sport gained its real first measure of truth. Suddenly, teams knew whether a pitcher threw 89 or 94, and the entire scouting landscape reorganized around that one number. Velocity became the defining metric of a fastball's quality. If you could throw hard, you were a prospect, and if you couldn't, you weren't. The radar gun suddenly had reduced years of myth-making into something simple and objective. But the story didn't end there. In fact, radar guns ended up only being the beginning. Eventually, teams discovered that velocity alone couldn't explain why some fastballs dominated while others got hammered by hitters. It was innovations in advanced tracking systems like PitchFX, StatCast, and high-speed motion capture that offered new data that revealed hidden dimensions of the pitch. For example, a high spin rate could make a fastball stay up longer than hitters expected, creating the illusion of rise. Measuring vertical break explained why some fastballs seemed to hop above barrels. Measuring horizontal movement separated straight four-seamers from two-seam sinkers. And what's really crazy when you dive in and start to learn more about this stuff is how organizations are measuring a player's pitch access and seam-shifted wake to see how these small differences in finger pressure or wrist angle make the air around the ball behave in surprising ways. Basically, what you're hearing here is that more data has taught us that a great fastball isn't just about speed. It's about characteristics or measurable traits that, once identified, can be optimized. Teams no longer need to rely on what looks good or sounds good. They now rely on evidence and build systems around it. And investing went through the exact same evolution. For decades, investors made decisions the way scouts used to evaluate fastballs, through instinct, stories, and appeal of the moment. People bought stocks that felt promising or popular. They sold when markets looked tired. The language, it was subjective, it was emotional, it's often misleading. Then the academics created indexes to measure the market's performance, and for the first time, investing had its radar gun. And just like velocity transformed scouting, indexing transformed portfolio management. Eventually, those academic indexes, originally created just to measure performance, became investable through index funds, giving investors a simple, objective way to participate in the market without forecasting. But just as baseball didn't stop with radar guns, investing didn't stop with indexing. Researchers began studying different characteristics of stocks, and why some earned higher returns than others, even when they carried similar market risks. They identified persistent traits like value, size, profitability, and momentum, and these weren't guesses. They were measurable patterns supported by decades of global data. They were the investing equivalent of spin rate and pitch movement, these hidden dimensions that explain why certain stocks behave differently. And so, with that parallel in mind, I want to move from the mound to the market squarely and talk about what distinguishes plain index investing from factor investing and why both approaches matter. Every investor owns a portfolio. If you put them all together, you get the market portfolio. That's just the combined holdings of everyone who participates in the market. Index funds are a simple, low-cost, transparent way of owning that portfolio. Before costs, we all earn the market return. After costs, the average investor earns less. That is the entire case for indexing. Keep fees low, eliminate the need for forecasting, and remove the emotional swings that comes with stock picking. Now, I think people sometimes point to the efficient market hypothesis as the reason to choose indexing, but that's actually not quite right. Jack Bogle cleverly framed it as the cost matters hypothesis, because all investors are the market. Everyone collectively earns the market return before fees. But once you subtract fees, the average investor falls behind. So keeping fees and costs low is one of the few guaranteed ways to tilt the odds in your favor. Bogle's framework is mathematically elegant, but it is also behaviorally liberating. You no longer have to worry about headlines or earnings calls or whatever the market's obsessing about this week. The market, you come to realize, is the sum of millions of decisions, and your goal is simply to capture that return at the lowest possible cost. For many investors, that's not just a good starting point, it's the entire journey. But those built-in choices do raise an important question. If the average investor owns the market, and a total market equity index is our best representation of the market, how are you different from that average investor? For many of the clients that we work with at PlanCorp, the biggest difference is structural. Their spending needs are small relative to their portfolio, so their investment horizon often extends beyond their own lifetimes. And so in a very real sense, part of their portfolio is invested on behalf of their heirs. So that combination of the long time horizon and the modest liquidity needs relative to the size of the portfolio gives those investors more capacity to live with some extra volatility and maybe some tracking error that comes with factor tilts. Now, a third essential ingredient is behavioral, and it's just being comfortable with returns that look different from broad market indices for years at a time. Now, if you can get those three things to be true for you, the longer time horizon, the modest liquidity needs relative to the size of your portfolio, and confidence in the strategy that you've chosen that will look different from broad market indices, but understanding why you're there, then perhaps making these small intentional tilts towards characteristics that have higher expected returns can allow you to bring a better outcome. And that's where factor investing comes in. It starts with the same philosophy as indexing. Rules govern the selection and weighting of securities, not forecasts. But instead of allocating purely by company size, factor strategies tilt towards traits that research has repeatedly linked to higher expected returns. The most widely recognized factors are value, which are companies that are trading at lower prices relative to fundamentals; size, smaller companies with higher expected long-term returns; profitability or quality, and people define them a little bit differently, but generally speaking, we're talking about businesses that generate strong, efficient earnings; and momentum, stocks with strong recent performance over the intermediate term. None of these are stock picks, they're rules, and they apply the same way to thousands of securities with no story attached. Why do these outperform? Typically, you can assign a risk or a human behavior story to the economic rationale behind these. Value stocks, for example, often face real business challenges, and smaller companies face volatility and financing constraints. Momentum investors live with abrupt reversals, and profitability comes with concentration risk. These risks justify the higher returns. But on the behavioral side, you see things like investors overreact, underreact, chase trends, and ignore those boring but durable businesses, and those patterns create persistent pricing gaps. Factor investing doesn't exploit secrets, it just really exploits discipline, and most investors can't stick with these traits long enough to benefit from them. How factor portfolios behave, I think that's really where the experience diverges sharply from plain indexing, because no one factor leads consistently. Value can lag for years, momentum can crash, small caps can trail during periods of fear or tightening financial conditions, And profitability can look pretty dull during speculative rallies. So if you tilt towards factors, you have to expect stretches where you look wrong. That divergence from the market, the technical term is called tracking error, and it is really just this psychological price of trying to outperform. And it's also why combining multiple factors matters so much. Because when you diversify across value, size, profitability, momentum, or any other factors that you choose to target, you realize that as one trait falters, another often steps up. It's sort of like the pitcher who doesn't rely on a single fastball. They're going to have different pitches to succeed in different counts and against different hitters. A diversified arsenal creates more consistent results, and a diversified factor strategy aims for the same thing. I've given you a quick introduction to indexing and factor investing. The question to me isn't really which approach is superior, it's more about which one can you live with. Here are 4 questions that I think can help you choose. Number 1, do you believe in the economic and behavioral logic behind factors? Number 2, are you willing to judge performance over decades and not quarters? Number 3, can you tolerate periods where you lag the S&P 500 or just the total global market index by several percentage points? Number 4, does the added complexity fit your temperament and your plan? If your answer is no to any of those questions, and this is especially true if you do not have an advisor, I really think that indexing alone is an excellent evidence-based option. But if your answer is yes, or if you have a no in there, but you have an advisor that you trust, I do think using an index core with a disciplined factor tilt can be a meaningful enhancement to your portfolio. Both approaches rely on rules instead of hunches, and either can form the backbone of a long-term portfolio. The key is really just knowing which set of rules you're best equipped to follow. If you want to hear more about my new book that will be coming out in 2026, again, you can sign up for updates at theperfectportfoliobook.com. As always, thanks for listening, and until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.